Welcome to today's iView Market Pulse. Let's dive into the latest developments shaping the global financial markets. We're spotlighting two major themes that emerged overnight. Trump's tariff reversal spurs market turnaround overnight. Former President Trump unexpectedly reversed course on previously planned tariff hikes, and markets rallied sharply in response. While we had flagged this as a likely policy shift, the official confirmation came later than anticipated, after several sessions of heavy selling and correction across global equities. Trump announced a 90-day delay on additional tariffs, including the supplemental 10% levies and broader penalties aimed at numerous countries. Although this postponement doesn't remove tariff risks, it opens the door for renewed negotiations, which markets welcomed enthusiastically. His comments on social media framed the move as a gesture of goodwill, particularly toward G7 allies, though tensions remain high, with the EU already signaling potential retaliatory measures. Importantly, tariffs on China were not eased but increased to 125%, signaling that US China tensions are far from over. This targeted escalation indicates that Washington sees Beijing as a strategic rival rather than a negotiation partner, intensifying the decoupling trend between the two economies. US Treasuries whipsawed amid technical macro pressures. While equity markets cheered, the US bond market told a more nuanced story. The long end of the yield curve saw extreme volatility. The 20-year Treasury bond dropped from 106 to near 101 over just a few sessions, a significant move in such a typically stable asset class. Several factors contributed. Liquidity-driven positioning unwinds among hedge funds engaged in basis trades, simultaneously long cash bonds and short futures. Margin calls triggered selling pressure on treasuries, adding to the yield spike. Concerns over potential Chinese divestment of US assets. While no official data confirms major Chinese selling of treasuries, reports from Reuters suggest Beijing has instructed banks to reduce US dollar exposure to support the yuan. Weak demand in a recent US Treasury auction further exacerbated the situation, pointing to buyer fatigue at current yield levels. Systemic risk remains limited, according to Treasury Secretary Skarbensky, but the liquidity stress in fixed income deserves close attention. This spike in Treasury yields complicates the macro backdrop as the US enters a period of heavy debt issuance. If China does decide to offload its US debt holdings in retaliation, it could further pressure yields higher and challenge US fiscal sustainability. US China trade war, from policy to full on confrontation, China has responded swiftly and assertively. In addition to matching US tariffs, Beijing issued a lengthy white paper outlining its efforts toward fair trade and cooperation, followed quickly by concrete retaliatory measures. Average tariffs on US goods raised to 100%, with specific duties hitting 84%. 12 American firms added to China's unreliable entities list. Administrative orders targeting US shipping access to Chinese ports. This tit-for-tat escalation underscores a broader decoupling trend that is unlikely to reverse in the near term. Trump's hardline stance and the synchronized retaliation from Beijing suggest the bilateral trade relationship may be entering a structural breakdown rather than a cyclical dispute. Macro implications, GDP, supply chains, and fiscal headwinds. The economic impact is already materializing. The new round of tariffs could shave 2.5%, 3.0% off China's GDP, prompting expectations for more domestic stimulus. Taiwan may see up to 0.48 percentage points in GDP drag, especially if third country rerouting of exports still triggers US tariff exposure. While the US may see a short-term bump in tariff revenue, estimated at $280–300 billion annually, the long-term fiscal benefit is questionable. Trade partners are already adjusting supply chains, potentially reducing their reliance on US markets. Additionally, global trading blocs are forming new economic pacts to circumvent US pressure, further weakening America's leverage. Europe and Asia are actively negotiating to diversify trade routes and deepen regional integration. Final thoughts. Risk on rebound or temporary relief. Markets are celebrating the short-term delay in tariffs, but investors must not lose sight of the longer-term structural headwinds. The US-China decoupling is accelerating across trade, technology, and capital flows. Treasury market volatility is symptomatic of deeper fragilities in financial markets. Global supply chains are realigning, and fiscal dynamics in the US are tightening. As we look ahead, the current rally may offer tactical opportunities, but the underlying macro risks warrant a cautious, risk managed approach. Stay vigilant, stay diversified,